Before we jump in today's video, I just want to remind everybody that I'm not a financial advisor. So this video is for educational and entertainment purposes only and should not be taken as financial, investment, or trading advice. All investments involve risk, and you should do your own research or consult with a licensed financial professional before making any investment decisions. Just remember, past performance is not indicative of future results. Everybody, it's Paul here on my channel, Better Call Paul, and back with us again today, our special guest, Katara from Tapp Alpha. He's the founder and CEO, and he has graciously accepted my invitation to come back on the channel now that they have launched two more ETFs to their suite. So now they're up to four. It makes sense, right? Because you had one, you went to two. Now that you have two, you might as well launch two at the same time.
The exponential curve, right? We're doubling. It's
Yeah.
it's a fun moment to be in.
Yeah, exciting. It's exciting. So I've been working on my TDAQ position. I think the last time we spoke, I had maybe 40 shares and I'm up to 350. So
Nice.
I'm buying 50 a week right now to get to 500.
I
So
love it.
yeah, I'm
Welcome to the
excited.
pool. The water's warm. Come on in.
Right? Now, for people who didn't watch, for the viewers who didn't watch our first interview and maybe haven't seen you interviewed on any other channels, you went into great depth on how TSPY works, right? It's not a traditional covered call with a 30-day strike or 30-day to expire?
Expiry.
Expiration, but it's a 0 days to expire. So what you were explaining is that instead of having one swing of the bat, right, you get 21, I think you said 21 to 22, basically every trading day of the month.
Correct.
So every day you get to reset that. And that way, depending on the market conditions, you can kind of like take advantage of it and get more premium. But you also mentioned that to mitigate risk, you could avoid a day. So if there's something coming up, something big, an earnings call or something being reported in the news, you guys can, not pick a strike that day, wait until it settles and then take advantage of it as well. Do I get that right, Sai, so far?
Yeah, that's right so far. Exactly right. The precision is really helpful. And then the one additional characteristic is because we're true zero DTE, we typically have our options in play only for the 6.5 hours of the trading day.
Mm-hmm.
So what that means is overnights and weekends, our long position is uncapped. And that's been really helpful for us to try and keep up and in some cases outperform the underlying because there's a lot of market movement overnight. That's when earnings happen or macroeconomic news comes out. It's usually when market is closed. And so if you don't have your option position on, your long will just capture all of what it's doing. And that's been really helpful for our performance.
And what I mentioned to you the first time was that I have a hard time buying TDAQ or TSPY at a discount because the price always seems to be consistently going up a little bit or at least maintaining itself. So for people who are afraid of NAV erosion, I find that your funds avoid that. And at the same time, I'm still earning that 14 to 17% distribution. But now you guys have launched two more funds. And from what I understand, there is a little bit of leverage. And I had somebody make a comment saying that I was too old to buy these funds. So I thought, you know what? I got to talk to Sai and find out what's going on. What did he do to these funds that I can't buy them? Maybe you can explain exactly what you've done, how they differ from the original two, and maybe who they're targeted towards.
Yeah, it's they're actually kind of Canadian inspired. Talk to some folks where light leverage has sort of been a norm in international markets, especially Canada. But that's really all we were trying to do is add two new characteristics to the performance of the core plus funds, TSPY and TDAQ. We just wanted to add a light lift, so 30% about additional exposure. And then we wanted to actually take the distributions and slice them up into weekly instead of monthly. And the reason for that, we had a lot of inbounds from investors that are comfortable with a little bit of light leverage and a lot of demand for the weeklies because of some of the characteristics around that. So we said, okay, we're at a good spot now where the core funds are a strong foundation and we're strengthening it every day. But how do we actually meet the demand for these kind of other requests that we got? And so we did the research to figure out how to actually build an exchange traded fund with just those two characteristics, leaving everything else as much intact as we could. And that's really what we tried to deliver. with T6, TSYX, and TDAX, TDAX, which are our two new lifted funds. And a lot of it was modeled after some of the light leverage that more traditional covered call funds will do. And there's a lot of Canadian funds that you can research and look at.
Oh, that's really exciting. So I know that a lot of people message me often saying, Paul, I really love the ETFs you talk about up in Canada where you have 25% leverage, but what do I buy in the States? Because I can't find anything. And I know myself personally, I'm afraid of funds that have 2x or 3x leverage. I think that's for a more, I guess, advanced investor, somebody who understands the swing trading a little bit better. But with the light leverage, it's to me, it's a no-brainer. Most of the funds I own do have 25% leverage, and it just brings the yield up a little bit more, right? You get just a little bit more exposure, and so I think that's fantastic. And weekly, now I'm excited. So
Yeah.
so you went for weekly. That's fantastic. So we can have, like I told you last time, I like to have a little bit of money coming in so that I could take advantage of buying opportunities. So that's great.
And that why was a big motivator. That's a good reason why having the weeklies makes sense to provide it to investors that see it that way. And so that was kind of what we wanted to do. And then, there were also a lot of requests. Can you make TDAQ and TSPY weekly? And for us, I think long term we're going to keep those monthly. And one of the main reasons is that product is both for kind of DIY and retail investors,
Mhm.
and advisors are using it a lot. And
Right.
advisors do not like weekly because it's just more overhead for them to manage for their clients. And so we kept that balance, but in order to meet the demand for the weekly, that's kind of the why behind creating a weekly product, and adding the light leverage together so we can kind of scratch both itches with this new product.
So I know different fund managers use different techniques. Some of them have synthetic shares. Some of them actually hold the underlying stocks. Some of them hold other ETFs. So would T6, would it hold TSPY? Is it holding the SPY? Or are you guys using some kind of a synthetic strategy?
We're actually, so I'll go through, we looked at every implementation choice, and there was only really one good fit. So we ended up implementing it using swaps. And swaps, it's really helpful and really important that everybody who's considering these funds understand what they are, the pros and cons of them. But we went through all four options, or choices, I should say. The first one was just traditional margin. So traditional margin, the hard part, when you just take a loan against kind of extra notional value, in an ETF, 40 Act fund, it's really expensive because of the way that the funds are structured. There's a custodian over here at one organization, and then the institution that provides you the margin leverage is in a different one. And so to collateralize it, it's really risky for the folks over here. And so they charge a really pretty penny to do it. So he said, it's too expensive. We don't want to do that. Synthetic exposure. So for folks that aren't super familiar with that, synthetic exposure means instead of buying the real equity, you're synthesizing the capital growth of the underlying equity by using options to synthesize the ups and the downs of it. The problem with that is normally when you synthesize, like we would use 1256 contracts, all that means is at the end of the fiscal year, if you're doing synthetic options, you have to mark to market what the value is in the last day of the year. And then as a fund, you have to pay out 90+% of that, even unrealized gain. So it pretends like it's realized. And for us, since we're like, we want to be tax efficient growth plus income, if we did synthetics, that whole growth bucket year over year kind of goes away because you have to distribute it all as income. So then it's just high income. So that wasn't a fit. Buying actual underlying shares, the challenge there is there's another rule in 40 Act funds that says you can't have a fund of funds of funds. So three layers of funds.
Right.
And our core TSPY and TDAQ, they both own ETFs within them. So if we bought TDAQ and TSPY shares, we would violate that rule. So that went out the window unless we totally restructured the underlying funds, which we're not ready to do quite yet. So then that left us with swaps. And I mean, admittedly, I wasn't super familiar. And that's also why we partnered with a company that's an expert in it. So Tuttle, Tuttle Capital Management is our partner on this, and they manage all of the swaps and they're experts in it. They know how to do leverage and they have all the relationships and really good pricing to do all of it on behalf of the fund. And what we learned was swaps are the cleanest and most efficient way and scalable way for us to implement what we wanted to do with just 30% light leverage on exactly the returns and the outcomes that the underlying funds provide. And so that's why we landed on swaps. And I'm happy to get into a little bit of definition of what a swap is and how it works.
Yeah, do you want to just briefly explain what a swap is? I know there are some other ETFs. I think Roundhill is one that uses swaps. So yeah, maybe just explain quickly
Yeah.
for those of us less educated.
Yeah, I'll keep it quick. And some of the implementations, like making sure that people understand the concept of a swap versus like some of the American implementations, how you use them matters. I'll leave it at that. But a swap is essentially, it's just a contract. Instead of owning shares, you now have a contract in place between two parties. So in this case, it's between the fund and an institution, a bank, where all that's getting exchanged are the returns, the outcomes of the thing in the swap, rather than owning the assets outright. So all we're doing, instead of owning shares of TSPY or TDAQ, we have cash, and then there's a contract that says at the end of each trading day, the contract says if the market goes up, the institution will pay the fund the total return times the leverage amount, which is about 30%. If the market goes down, same thing in the opposite direction. And so that's really the concept of the swap. And the analogy I've been using, it's probably terrible, but I'm all ears for more improvements.
Yeah,
But it's the idea of like traditional owning shares. You own the orange tree, you grow the orange, you pick the orange and you squeeze it in order to get the outcome, which is the orange juice. And the swap, the analogy is just you just buy the juice and you don't have to go through that other process. And so it's a really clean way to manage it. And of course, there's a cost to a swap. So just like margin, you have to pay an interest rate.
right.
There's a fee, which is based on an interest rate plus a spread for the banks, institutions to want to do it. And then if you, like as the funds grow, you increase the swap amounts. When you do those increases, there's a commission that's charged by the brokers to do that. So those are the two costs that you have to be aware of, which is kind of what people talk about with swap drag. But that is the implementation of what swaps are. They're a really handy tool, and they can also be used. The other piece is people are asking, is it tax efficient or not? When you use swaps, there's actually a potentially tax efficient way to manage the growth and a potentially tax efficient way to manage the distribution. So that's one of the core reasons why we chose swaps is the best solution to implement the fund.
Yeah, people always ask me whether or not, funds are tax efficient. And of course, I'm not an accountant, but I find that a lot of times fund managers, CEOs such as yourself, try to figure out the most tax efficient way of doing it. And what I always suggest to people, especially in Canada, is just hold these funds in your registered accounts, and then that way you don't have to worry about the
You
tax
don't have to worry about it,
implications,
right?
right? Another question people seem to, or an area that people seem to dwell on, is the fees. So would the management fee be the same for these funds?
These are higher. So these are 98 bips versus 68 bips. And the
Okay,
reason for that is there's two operational overhead pieces and a lot of value added. The first operational overhead is swaps because we do total return swaps that are sort of like, they're reconciled or sort of settled at the end of the day. It's overhead every day to manage that and then
mhm,
have the back and forth. And then the second thing is the weekly distributions. It's 4x the work because you're doing a distribution every week
right.
instead of every month. So the additional work needs additional people and resources to manage it, plus the value. You're getting a really fair price on potential leverage and you're getting more frequent distributions. And so at 98 bips, people seem like, oh yeah, the value is there. We don't mind paying the difference versus obviously our core funds are 68 bips. So there is a price delta there.
Right. I know you can't really talk about, I don't think you can talk about yields or, performance because the funds just came out. They haven't been out for a
Yeah.
year now. But would it be reasonable to expect that T6 would be almost 30% higher than TSPY?
That's the thinking. That's the design of it. But I wouldn't say higher. I can't guarantee higher or lower. It's
Sure.
30% added exposure. So
Okay.
if the market goes up, you would get about 30%, and there's a little wiggle room on what the leverage is because of, markets move every day.
Sure.
And then the second piece is there's a little bit of drag. So every day the interest and the commissions kind of come out a little bit of the NAV. So you got to watch that. But this isn't 100% or 200% leverage where that's a significant factor. It's a smaller factor, but it is definitely something to be aware of. And then the biggest thing that, people understand, like these movements are now amplified by 30% in either direction. So on the downside too. And this math doesn't have to do with leverage or not. This just has to do with straight math. But think about an investment where you have $150. And if that investment loses 50 of that 150, you've lost 33% or, a third of that.
Yeah,
In order to get back to the 150, think about where you are. You have 100, but you need to add 50.
that's right.
That's now 50% of your total amount that you have. So that's just how the math works in down markets. It's harder from a percentage perspective to get back up. And so that applies not only to standard funds, but when you have leverage, those movements are now bigger in either
Right.
direction. So just keep that in mind to make sure that the downward movements potentially are things that your risk profile can feel good about or feel okay about.
Yeah, I find that some people they're very excited when the market's going up and leveraged
Yeah.
funds go up, but then when the market goes down, they get very upset. There's my dog. They get very upset that the fund is dropping as fast as it is. But you have to take the good with the bad when you deal with leverage. But over the
Yep.
long term, I think they will outperform. Otherwise, I wouldn't hold them.
Yeah, that's exactly the goal. And you can't predict what the markets are going to do, but that's the why that people would hold them. But just be aware that it is amplified in both directions.
So, Sai, would you say these two new funds were designed for a different type of investor than would hold TSPY and TDAQ? Or
There's likely some overlap, but really the differences are a couple things. So number one, it's really comes down to risk profile and timeline. So like if you have a super short timeline, it probably doesn't make sense to go into a levered fund because if something goes down, you don't have the time to like weather the storm.
right,
So there's just more risk of that compared to the core plus funds where, they won't have the amplification. The second thing is the risk profile. So because there is an amplification, like it feels great when the market goes up. So like this is amazing. You see the more green than you do with the core funds. But the flip side as a trade-off is you get that same impact on the downside. So if that like downturn amplified gives you anxiety and it doesn't fit for your risk profile, then these products probably aren't for you.
right.
But really, those are the two things to sort of keep in mind when considering the funds. But if you have a long time horizon, if you have a medium risk profile, like this might be a good solution, especially if you have conviction that over the long term markets, are likely going to rise. If that's how you feel, then if they are, having a little bit of light leverage actually could be a really good thing because it fits with your thesis.
Yeah. I was trying to debate whether or not I should just sell, my TSPY and TDAQ, put all the money into the new funds. But what I'm hearing from you and what I'm thinking is for myself anyways, keep what I have. And that's kind of like a good base, a good strong foundation. And then
Mm-hmm.
add in a splash of the new funds for a little bit more yield and a little bit more, I guess, volatility, and I can manage the risk. For me, I'm not too adverse to it. Some people don't like to see their portfolio swing up and down, but I'm okay with it. So I think these are going to be a great addition to my portfolio.
I love it. No, that's great. And it's really important. You seem to have an understanding of leverage and kind of the risks around it. And so I think that's why it's a quicker decision for you. And it seems like in Canada, just because there's more opportunities and more funds that are out there and more choices, that this concept in general seems to be pretty well adopted. In the US, there's not a lot of these types of options or choices out there. And so that's why I think it's a little bit new. And I think that's where the education is so important so that people can get comfortable with it before they end up investing in something that they don't necessarily understand. So number one, it's understanding and just making sure that it's a fit for your goals. That's really what we're trying to get out and share. But it's really important also for people to do their own research because leverage, it adds a new dimension to things that if you don't have experience or understanding of it, that you don't want to put yourself in a position that you weren't prepared for.
Yeah, no, you're right. You're right. And I think what we've noticed in Canada, a lot of the finfluencers and people like Adriano from Passive Income Investing, who have been doing this for quite a while, is that covered call ETFs, they lag a little bit, maybe because they cap the upside, but the additional leverage helps you catch up to the underlying holdings. So it's great.
That was exactly the why of kind of the why the leverage and why it's used in Canada. And then for us, we looked at that and said, oh, great. Like if that model's kind of been proven there, in this case, our new thing and our expertise is zero DTE. And if you look at the history and the performance, zero DTE has actually helped us keep up
Mhm.
with the underlying without leverage. So if we take that same idea and add leverage, maybe it gives us a shot to outperform in a way. And so that was the thinking in actually building the products originally.
All right, no. So here's the exciting thing. Are you guys thinking about some new products? I know last
Yes.
time I mentioned I think sector ETFs. Anything maybe coming down the pipeline or
Yeah, we're working on some things right now. It's one of those things like I'm a true engineer and I like to scale a really strong foundation. So
sure.
everything we're building is sort of pumping back into the core that we built. And the core is based on like providing tax efficient growth plus income. And the method that we do it, we use ETFs because they create access. We use zero DTE and we use technology all put together to create those outcomes. So like as we launch new core plus tickers, all the experiences that we'll get from those will feed right back into the fintech to strengthen the capabilities of even our original fund. So that's the goal. And so we're looking at strategically adding new tickers that will help us kind of continue that flywheel process. So we're thinking about a couple more core plus additions that hopefully we'll get to market when it makes sense. And the other thing too, it's really important just so people understand my thinking. Um, I don't want to do anything that takes away from the foundation. Like I
Mhm.
want to make sure that we're not throwing spaghetti at the wall because people are asking for X, Y, and Z. I want to be really strategic and deliberate because I want to make sure the quality of everything that we put out is going to be rock solid and continue to build that flywheel. So that's a long-winded way of me saying yes. And the why, we're probably looking at some more core plus funds with different securities underlying using the exact same strategy and the same infrastructure we have to execute.
Excellent. Okay, I have one more question for you, Sai. This is something I was talking to another YouTuber yesterday about because I'm 52. I'm obviously still young enough that I could work, but I'm kind of considering being semi-retired and using my portfolio to pay for some of my bills. So, assuming that a fund like TSPY stays NAV, like the NAV is stable as opposed to NAV erosion, do you
Mhm.
think that somebody could withdraw all of the distributions and live off of it, or would you recommend, sort of a percentage being reinvested back into the funds?
Uh, it's hard for me to give advice on that. I will say this. It's impossible for me to know what the markets are going to do in the future,
Of
right? So if
course.
markets go down, there's going to be impacts on the core of the funds.
Yeah.
Like that is a risk that is within the funds. And the recommendation that I use in my life is if there's portions of the income that's coming from the funds that I don't need, that's one of the reasons why we're focused on tax efficient distributions, because I can tuck it right back into the fund without a leaky bucket from the tax perspective. Currently, since I'm building a startup, I use all of my distributions from TSPY. And I'm so happy to see that the NAV is going up and that my distribution absolute dollar amount is also going up because the NAV is too. So far, that's been the use case for me is I use 100% of distributions and I'm getting a little bit more over time since the fund is growing. But again, everyone has to consider their own circumstance and their own risk tolerance and their own needs when they're making those sorts of decisions.
Yeah. I've come to the conclusion, side that I've been chasing so many of these ultra high yielders for the last couple of years. And even though they're boasting, 50%, 60%, 100% yields, if the share price goes from $30 to 15, I've just lost half my investment. So for
And
me, it
the
doesn't make sense
effective
anymore.
it's such a smart perspective because it used to be top line yield and distribution was the only thing that people considered, but now people are understanding like endurance matters. It's
Yes,
not just a distribution, it's how long can that distribution last you?
that's
And
right.
those are the things to match against the needs. And that's really why we're focused on this category that didn't really exist when we came on the scene. It's growth plus income. And you can't just do income and not actually consider growth because your nest egg will shrink. And if your nest egg shrinks, the thing that actually generates the income will also shrink.
That's
So our
right.
goal is to provide products that give you a balanced approach to both growth and income.
Yeah, definitely. NAV stability. What I'm saying now is quality. Quality over quantity is what I'm trying to do with my portfolio. Reduce the number of holdings I have and adding more positions to not positions, but adding more funds to ETFs like TDAQ and TSPY that have been so far have been great. Um,
Awesome.
Sai, I'm going to link our first interview to this video for anybody who wants to go back and get a better understanding of how TSPY and TDAQ work, because I think you really explained it so well. But I just want to say thanks so much for coming back on the channel, and I can't wait to see what you guys do next, and hopefully we can chat again when you do.
Look forward to it. Thanks so much for having me, Paul.
All right, thanks, Sai.